most traders are trading yesterday, while the smart money is pricing tomorrow. See, we have two major catalysts converging. And if you understand this narrative, you aren't just guessing. You're watching the script play out exactly as it's been written. Let's look at the first piece of the puzzle. Look at what Fed Williams, the president of the New York Fed, which is very important, I'm going to tell you why in a second, said on Friday. Now, the New York president is the most important position at the Federal Reserve after the chair. He's the vice chairman of the FOMC, and he's the only Fed president with a permanent voting seat. So this is not a random guy with an extreme position, just talking about for clout. This is the guy who whispers with power about what to do next. So these comments, or this context, take on a whole bigger meaning. Now, look at what he says. Downside risk to the employment have increased. Fed Williams says tariffs have increased prices but are not expected to lead to persistent inflation. He's telling you we're not going to care about inflation going up a little bit. We're caring about the downside risks to the labor market. And for that reason, Fed Williams sees still room for a near-term cut, which means he thinks a December rate cut is likely, and actually is the most likely scenario. So all these comments signal a rate cut at the December FOMC meeting. Now, if you're waiting for the Fed to actually cut rates to react to it, so to sell the dollar or whatever, you are the excess liquidity. See, markets move on expectations, and the trade is shaped way in advance of the actual event. This is the essence of buy the rumor, sell the fact. The smart money has listened to what Williams said now, and it's already pricing in that expectation. By the time the Fed actually cuts 25 basis points, the move is gonna be pretty much over, whatever. So that said, the narrative here gets even deeper. We have a second catalyst to watch. Apparently, Kevin Hassett is becoming the favorite candidate for Trump's new Fed chair nominee. Why does this matter? Because in a world of central banking, stance is everything. We categorize officials as hawkish or dovish. So hawkish meaning aggressive on inflation, higher rates, tightening monetary policy, all of that. Dovish is the opposite, propense to stimulating growth, lowering rates, all the good stuff for markets, and bad stuff for the currency. Now, Kevin Hassett, is the definition of a dove. On a scale from hawkish to dovish, he is off the charts. He favors easy monetary policy by cutting rates as much as, not what he wants, but as much as Trump wants. And Trump wants rates as low as possible. So, do the math with me here for a second. We have the current New York Fed president, so Fed Williams, an important voice at the Fed, second only to Powell, signaling a rate cut in December. And we have Trump about to pick the next Fed chair, which obviously will take the role only mid next year. And so, here's what 95% of traders get this wrong. Novice traders think, oh, okay, I'll think about that in 6 months. Wrong. The market is a discounting mechanism that pulls future expectations into current price. So the moment Trump announces a new Fed chair, Kevin Hassett, the bond market will react immediately, repricing where rates will end up next year. It will do that right now. The market will not wait for the day the new chair gets in office. It will start to expect rate cuts in every meeting thereafter, and it will price that right now. So bond yields will drop, okay? It will get lower and lower, expecting easier monetary policy ahead, expecting rates to be, 2% next year, whatever. And so bond yields dropping as they anticipate lower rates next year, and since yields drive the attractiveness of a currency, when US yields drop, the dollar drops too. In fact, notice the reaction on the news release on Euro USD. As soon as the market got the news release that Kevin Hassett was emerging as the top pick as the Fed chair search, the dollar sold off and Euro USD went up on that news. So again, do the math with me here. We have a heavyweight at the Fed, the New York Fed president, laying out the grounds for the December cut. Perfect. That is dovish. And we have the future political regime signaling a structural shift towards easier monetary policy, regardless of what will inflation do. That is very important, especially for gold. But for now, this video is about the dollar. So Trump is about to pick the most dovish Fed chair he can, and that is also dovish. So what does that tell us for the dollar? Well, it tells us that it's most likely to move lower. This is fundamental analysis. We just created a macro view based on the information that we have right now. So we built a view with the information that it's available to us right now, okay, to assess how things are going to most likely move, most likely going to unfold. Right now, we know the Fed is most likely going to cut rates in December, and we know that Trump is about to nominate the most dovish Fed chair possible. 1 + 1 equals a bearish dollar view. Will it move in a straight line? Absolutely not. Is it a certainty that it will weaken? Absolutely not. We are trading probabilities here. Things can change, the context can shift, the data ahead may show a strong labor market which will allow the Fed to stay on hold. We don't know, we cannot predict exactly the data. We can have a view on how the data is going to unfold, and based on that, trade the probabilities. But we cannot be certain about anything. So what we can do is just trade the most likely scenario out of the various possible ones. And after that, just be patient. So if you want to see how this continues to unfold, make sure to like and subscribe so YouTube will notify you about our video uploads.